I want to get to Japan in a minute, but really, we got to talk about the sell-off in China. It seems like there's this whole renewed, intense selling here right now. Are you seeing signs of panic? What's going on?
Well, there's definitely signs of capitulation, Yvonne. And I think that there are a couple of things that explain it. One is I think there's a clear recognition that China is facing significant structural challenges. Those are, I'm sure, are well known, but they're, I guess, broadly more in concerns over the property market, over debt, over demographics, over slowing growth, and so forth. There's also been concern that there has not been as forceful a policy response as people have been hoping for. And so there's been this progressive slide in the market, punctuated by occasional rallies, but when the actual policy which has been hinted at doesn't fully come through, then people have been selling that. And then the last thing I'd say is that there's some technical factors in the market now, which particularly in this last week or so have been exacerbating the downturn. And that's that there's a variety of derivative structures,
Snowballs,
retail snowballs and so forth, and we're hitting knock-in levels where the hedges against that have to be unwound. So there's some forced selling in the market, and I think that's, and people know about that. So either the selling itself or the recognition that that selling is to come has caused the market to come down even further.
I mean, you take a look at a Hang Seng right now, the sub 15,000. I mean, we're back to handover levels.
Correct.
Valuations, I think everything is below 0.9 book.
Right.
Are we reaching a bottom in valuation yet?
Well, I think we certainly are. If you have any contrarian inclination, the bells have to be ringing. And just to put some numbers on that. So we look at the MSCI China Index. It's the broader, I think, more representative index, but it overlaps with Hang Seng quite significantly. So that's down 62% from its February 2021 high. As of last night's close, we were at 7.9 times consensus forward earnings. To benchmark that, we're 18.3 times at the peak in February 2021, and the low just before the 55% reopening rally was 8.1. So we're even below where the reopening, in valuation terms, where the reopening low was. So I think we're at levels where the market is pricing in a great deal of distress, and that suggests to us that there should at least be a chance for some sort of contrarian, or even if it's a bear market rally, it could be a significant one that could be coming up.
So you've neutralized your underweight on Hong Kong.
Correct.
And then now you're still overweight A shares.
A shares, and we're more cautious on the H shares. We're differentiating between those two, A and H.
At what point does this become somewhat problematic? It's systemic in some ways, right? And what needs to change, right? Is it still bigger stimulus that's going to arrest these declines? What else?
So we just put out a paper this morning thinking about or addressing the question of what would be needed in order to turn the market around. And there's a lot of different areas you can talk about, but to put it all into sort of more manageable buckets, I think three large categories. One, I think there needs to be a more sufficient policy response, but not just discussion of that, but also implementation. And the market right now is in a mode where there's been a lot of promising of policy action or indications of that, but not as much delivery on it. And so I think the psychology is one of, you could call it show me the money. You have to show me the evidence of that. I think the best evidence would be actual monthly economic data indicating that there is some bottoming or stabilization in terms of the overall economy, and that could either be through supply-side actions or demand-side stimulus, but some sort of policy response. That's number one. Number two, we're right into the reporting season. I think the delivery of corporate profits is going to be important, because if underlying profits can come through at these valuations, then sentiment may stabilize. And thirdly, I think that the political rhetoric or the political news flow probably just needs to calm down somewhat. I think there is market concern over renewed intensification of anti-corruption and so forth. And I think that is also causing some distress among market investors.
You mentioned earnings. I think MSCI China earnings projections for this year are around, what, mid to high teens?
Correct.
Is that ambitious, do you think, right now?
Very ambitious. So there's good and bad news here. The bad news is that the consensus is looking for 16% EPS growth for MSCI for 2024 this year. We're at 8, so there's the biggest gap between our numbers and consensus. So that suggests there still is a round of downgrades that have to come. The better news, and I was just in Europe last week seeing a number of different investors, is that I think the buy side, the investors, are either at our numbers or even a bit lower. So I don't think that the downgrades will be as market injurious as you might otherwise think. I think that's been pretty much priced.
Obviously, you mentioned about this intra-regional disparity, right? Where North Asia has done well.
Yeah.
China, Thailand, on the other side of this. Does that continue in terms of what you're hearing in terms of foreign investor sentiment?
For sure. And just to put some numbers, so the MSCI index, MSCI Asia Pacific ex-Japan index was up 5% for 2023. Underneath the surface, there was a 35 percentage point difference between the best performing markets, Taiwan, Japan, Korea, and so on, and the worst performing, which are Hong Kong, China, and Thailand. And interestingly, that's carried through just in the first 3 weeks of this year, where China's down 10 to 12, and Japan in local currency is up 6, 7, and dollars up 3. So 15%, if you keep me score in dollars, 15% in the first 3 weeks of the year. Phenomenal, right? So really the point we're making is that under the surface of the broad index, there's a lot of alpha and differentiation opportunity. That could reverse, but the point is you need to play the game under the surface as opposed to just passively investing in the region as a whole.
Okay, favorite market here right now before we go?
Japan, Korea, India. I'll give you three.
It's still those.
Yeah, it's still those.
Yeah.
I mean, Japan is the bottom-up corporate change story. India is structural growth. Korea is the best cyclical recovery in the region. Short and simple.